Everybody, welcome back to another video. Today we are going to talk about Sofi. Sofi is going to be reporting earnings on April 29th at 8 a.m. Eastern. So in today's video, we will touch upon this article. We'll take a look at those three particular reasons. We will take a look at the earnings estimate. We will take a look at the earnings growth. We will also take a look at some data that you should be aware of if you are planning to buy or sell Sofi after the earnings call. So if that is something that you're interested in, keep watching, and without further ado, let's dive in. Alright, let's jump straight into this article. Don't be fooled by the Q2 bounce, which means that writer is expecting a bounce on Sofi. So in this article, the first reason they talk about that you should not be buying Sofi on the bounce is because the macroeconomic picture isn't looking great. Well, they're talking about the interest rate cuts that was expected to be 4 or 5 for this year initially, then it dropped to 2 to 3. Now there are maybe you will not get a single rate cut, maybe you will get one, maybe you might even get an interest rate hike. The problem is that nobody can predict that and everybody is making assumptions, including the pundits on CNBC or any other Bloomberg channel. Until something breaks in the economy, there's no reason for Fed to cut interest rates. Stock market is making all-time highs. Stocks are making all-time high. You have inflation being sticky. So if inflation remains sticky, why would the Fed cut interest rates? Because bringing the inflation down to 2% is what their goal. Now, unless they are faking it that they don't want to bring it to 2% and they want to keep it at 3%, then that's a different story altogether. We have elections coming up. So most likely you may see some more pressure on the Fed, maybe in the third quarter, right after June, July, when the election season picks up. So we'll see how that plays out. But if you are an investor in Sofi or any other stock, this is a micro event, which means its impact is for 3-6 months or short to medium term. In long term, these events will not matter to your portfolio. They are saying Sofi valuation is still too high. Now, if you're looking at Sofi's evaluation from a PE standpoint, yes, it's 105. If you consider Sofi as a bank, then on the sector median, the forward PE ratio is 10.56, whereas Sofi is 105. So from that perspective, yes, Sofi is an expensive stock. However, Sofi is a growth company. The third reason is downgrades on the Sofi stock. Upgrades, downgrades, they happen all the time. And what the writer is saying that not everybody has a doom and gloom opinion. Some smaller Wall Street firms, including Kaye, Brewer & Woods, and Needham, have a more optimistic view on Sofi. Let's say if we start from March, Wedbush has reiterated their price target is dropped from $8.05 to $8. For Jefferies, the price target has dropped from 15 to 12. For Needham, which is $10. For Kaye, Brewer & Woods, it's gone up from 6.5 to 7.5. And Citigroup maintains a $11 buy rating. If you remove Wedbush from here, you're looking at anywhere between $8 to about $11-12 is what Sofi price targets are. Now keep in mind, these price targets are for an year. However, these companies will revise their price targets every quarter. So in a sense, this is a moving target and you should not be paying too much attention on the price targets if you have a very long-term horizon. Okay, so what can we expect from Sofi's Q1 earnings preview? Consensus EPS estimate is minus 0.1, which is going to be an 80% increase year over year. Nothing to sneeze at. The revenue estimate is $558 million, which is an increment of 21.5% year over year. From the last 2 years, Sofi has beaten EPS estimates 50% of the time, and they have not missed a single revenue estimate. So you can be 100% sure they will be getting this revenue. And this is exactly what that article is talking about. You can see that there has been not a single revenue miss, and they have missed maybe 2 times here and 2 times they came in line. If you look at their revenue estimate for the next 2 to 3 years, December 2024, they're expected to have a revenue growth of 14.87%. That goes up to 16.94% in 2025, and in 2026, they can even go up more than 21%. Now, let me show you an example with a regular bank. Now, this is JP Morgan. If you look at JP Morgan's revenue growth, you are getting 5%, 2%, 4%, like that. This is the reason why you really cannot compare SoFi with a traditional bank, because SoFi's growth is in the teens and that is a pure growth play. And this chart for member growth for SoFi has been tremendous. This company is growing members in the higher 40s for a while now. And you can see this company from 2020, when you had about 1 million members, going all the way to now 7.5 million members. That's an amazing growth rate. And I expect this growth rate to continue for the foreseeable future. We can see a similar trend whether we are looking at lending or financial service products. This company continues to grow in double digits. And again, this is the reason why this company has higher valuation, or it's traded higher valuation, because it is a growth company. It is bringing that massive growth that you don't see in your traditional banks. Now, if you're going to be trading SoFi next week, you need to have a couple data points in your mind. Number one, look at the put to call ratio for next week. It's 5.3 expiration. Our put to call is 0.53. So generally, SoFi has a lot more call options open against the put option because it is a retail favorite stock. The implied volatility is 149%. So if you were playing options, if you were buying options, you probably paid a lot. If you're selling options at this point in time, you probably got pretty good premiums on it. Also, another data point you need to keep in mind is generally the implied move post earnings is about anywhere between 13 to 16% that you will see the move on. This is a daily chart for SoFi. So currently the stock ended at 787. So if we are looking at an upside of 12 to 16%, you could see the stock going up to $9.12. This is where they were pretty much in the middle of February, by the end of February. You see this massive gap up. The stock was trading around the 760 mark, and then post earning, the stock shot up all the way to 940, but pretty much closed down at 917 or so. And then since we had this massive gap up, then the next couple of days, the stock pretty much filled that gap up and then, pretty much has been trading in this range itself. Now, if we see a downside, you can see the stock probably making a gap down all the way going to about 661. That would be the line. I would really want to watch is this particular area, which is the $7 mark, because this is where most of the buying tends to happen for the stock. And let me show you why. If we open our fixed volume profile and we draw it right here, you can see that at these levels, you do have some volume shelf. So decent buying happens around this level, especially since as the stock has been trading over here. At this point in time is below its 200-day moving average. So my personal philosophy with investing is that when stocks that I want to own for long term are trading below its 200-day moving average, I tend to add them. Also on the RSI, the stock has been trending upward from the last couple of days because we did see a little bit more buying in. So the RSI is 59.35. You can see that there is the volume slightly picked up on the last trading day, which was Friday. And you are watching this video probably on Sunday before the market, before the earnings call. If we see a strong earnings report and strong guidance by the company, we could see a gap up over here, and maybe in the stock may go all the way up to 912. The short interest on SoFi currently is sitting at 18.14%. So we could see if the stock has a massive gap up, we could see the shorts doing some covering, and that could push the price even further high. That if you see a major gap up, you could see declines in the next couple trading days as well, because this is generally how the trend of SoFi is. Now here is my trade currently that is in progress for SoFi. I had opened a $7 put, expiration of May 17th, and the premium that I got was 43 cents per contract. So since I opened 10 contracts, I got about $433 in premium. On May 17th is $7 or below, I will have to buy SoFi at $7. However, because I got 43 cents as premium, I'm looking at about $6.57. That will be my actual cost basis. Time of this recording, right before the earnings, I'm up about 67%, which is about $163. There's about $270 intrinsic value left in the contract. Now this is how I'm going to be playing it. If we see a massive gap up on SoFi, I may go ahead and close this contract, free up my capital. If there is a massive gap down in SoFi after earnings, I have enough time left on the contract for expiration and I will let it run. And in case the SoFi goes to $4 or $5, which I don't expect it to be, I can always go ahead and roll those contracts to keep collecting premium. So that was the status on my trading. And what you could do is wait for the direction on SoFi after earnings, and then I'll probably make another video and say what are the next trading ideas for SoFi. So let me know in the comments if you are currently trading SoFi and what are your expectations from the earnings report. I will see you next time, investor family, but don't forget to invest for tomorrow.